If you're a high earner with a brokerage account, you could be paying thousands of dollars each year in taxes and not even realizing it. Today, I'm breaking down the 5 biggest mistakes that I see high earners with brokerage accounts make and how you can go about fixing each of these mistakes. And before we jump into the video, my name is Ryan Knoll, and I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. Now, before we jump into what each of the mistakes are, I'm going to first tell you how you find your taxable income. And taxable income is important because the amount of taxable income you have in a given year will determine your capital gains tax rate. And all your taxable income is your adjusted gross income less your standard or itemized deduction. And this is essentially the amount of money that you will be taxed on after taking away all of the appropriate above the line and below the line deductions. So for a single person who makes less than $48,350 a year in taxable income in 2025, you'll pay nothing in the way of capital gains taxes. But if you make between that $48,350 and up to $533,400, you will be taxed at 15%. And anything above that upper bound will be taxed at 20%. Now, on the screen here, you'll see a table for all tax filer statuses, so single, married filing jointly, married filing separately, and head of household, and how this would apply, but that logic will work the same. If you're below the low end threshold, you'll pay nothing. If you're between the lower and upper bound, you'll pay 15%, and if you're above that upper bound, you'll pay 20%. And it's really important to know where you're going to fall and how to start planning for where you're going to fall early in the year, so that way you're not realizing more in the way of capital gains taxes than you have to. And later, we're going to talk about how state taxes and something called net investment income tax factor into this as well. But the major takeaway here is if you're not careful, you realize capital gains annually, and you make a decent income, you could very well be paying more than the 20% at the highest capital gains tax rate when everything is all said and done. So let's jump into the mistakes that I see most often. We'll work through some examples and how you could go about correcting these as well. Now, the first mistake that I see is dividend tax inefficiency. When you hold high dividend paying stocks or ETFs or mutual funds inside of a brokerage account, you're going to pay taxes on those dividends as you receive them during the course of the year, even if they're reinvested. Now, the extent of the tax is going to depend on whether they're qualified dividends or non-qualified dividends. Qualified dividends are going to be taxed at capital gains tax rates, so you'll find out your taxable income, see where you fall on that table we just went over, and that'll be the rate that you pay on a qualified dividend, whereas non-qualified dividends are taxed at ordinary income tax rates, which could be as high as 37% if you're in the highest marginal tax rate. And the difference between qualified and non-qualified dividends typically comes down to how long the holding period's been. If you held a stock for 61 of the last 121 days before the dividend was paid, typically you'll fall under qualified dividend status. If you don't meet that time requirement or that time threshold, you're going to fall as a non-qualified dividend. Now, there's some other things in there that might be a little bit more nuanced per se, where it might preclude you from taking a qualified dividend as opposed to non-qualified dividend. We're not going to get into them there, but I just want you to be aware of the timing aspect of things, because that's typically going to be the precursor to determine qualified versus non-qualified. And this can have a huge impact when you're retooling a portfolio. I've seen investors rebalance a sizable portfolio that pays dividends in the range of tens of thousands of dollars. Now, let's just take $10,000 as an example. Let's say when you retool this portfolio, if you're taking something that would have been a qualified dividend, and now you're making it a non-qualified dividend because of the new securities that you're holding in that portfolio. So $10,000 at the highest qualified dividend tax rate would cost you about $2,000 worth of taxes. But if you're in the highest ordinary income tax rate and now are paying non-qualified dividends, you're going to pay $3,700 just at the federal tax level. So it literally doubles the amount of tax that you have to pay simply because you rebalanced a portfolio. And that's why it's so important. We're going to go over a brief example here to help solidify this for you, but it just goes to show you why you should be cognizant of when dividends are being paid in and when you're rebalancing a portfolio, because the tax implications can be huge. Okay, so let's walk through this example here where we have 2 investors. And the first investor, her name's going to be Alice. And Alice has done a really, really good job saving. Let's say that she has a $500,000 portfolio, and that portfolio pays her 4% in dividends each year. So we know that Alice has dividend income of $20,000 in a given year, which is great. And let's say that we know that she's held this stock for 61 of the past 121 days. None of this dividend income is coming from something like a REIT, which would make it a non-qualified dividend. So all of her dividends are going to be qualified. We know that qualified dividends are taxable at capital gains rates. So when they're taxable capital gains rates, we're going to assume that she's in the highest capital gains tax bracket of 20%. And we're going to throw out net investment income just for the sole purpose of this example. But we know that this all means that Alice is going to pay $4,000 in tax. So she's $20,000 worth of dividends are paid in, $4,000 of that has to go to Uncle Sam. So essentially she's making a little over $1,000 a month when it comes to her dividend income for the year. Now, let's say that Alice has a good friend and her good friend name is Dave. And Dave does one thing. He copies Alice. And we know that Dave also has a $500,000 portfolio. And let's just assume for simplicity's sake that all of the dividends are paid at the year end for this portfolio that Dave and Alice are investing in. Now, Dave doesn't have a qualified dividend status because he hasn't held these stocks for 61 out of the last 121 days. So he's going to have the same $20,000 worth of income, but his tax is going to be 37% because he's in the highest capital gains, or he's in the highest ordinary income tax rate. And because these are non-qualified, they're taxed at ordinary income tax rates. So his tax on this is going to be $7,400, which is $3,400 more than Alice, almost double. And his take home is only $13,000 or $12,600. So he's making just about $1,000 a month in terms of these dividends if we were to break it down on a monthly basis, whereas Alice is making somewhere in the ballpark of, $1,250 a month. So you'll see here why it's so important to understand where you fall from a qualified versus a non-qualified dividend standpoint and how this drives tax-related decision-making. The second mistake that I see a lot of high-earning investors make inside of taxable brokerage accounts is they accidentally trigger something called the wash sale rule. And basically what that means is that they sell an investment at a loss and then rebuy that same or substantially identical investment within 30 days. And then the IRS will actually disallow the loss and you lose that valuable tax deduction for the year. So take Bob, for example. He sold XYZ stock at a $5,000 loss, but then 2 weeks later, he turned around and bought it again. Because he did not wait the 30 days, he can't deduct that $5,000 loss this year. And what ends up happening to that $5,000 loss is it's added to the basis of his new purchase. So let's say he purchased the original share amount at $10,000. He sold it at a $5,000 loss, meaning he collected $5,000 of loss, but then he went and he purchased that same security at $8,000. So that his basis in the new security would be the $8,000 purchase plus the $5,000 disallowed loss from the wash sale. So his new basis would be $13,000 on his repurchase. So you lose the ability to collect that loss right up front. So to avoid this, we always want to make sure we're waiting at least 31 days before buying back the same security. If you want to stay invested, you can swap into a similar but not completely identical security. So a good example of this would be like, let's say you sold Apple stock at a loss and you want to buy something that's similar but not the same because you don't want to invoke the wash sale. You might turn around and buy Microsoft just as something to fill the place. It's going to have a correlated return and it's not going to be completely different from the security that you sold previously. And if you're planning to harvest this loss, make sure you turn off things like automatic dividend reinvestments because these could trigger a wash sale by the virtue of going back and repurchasing that security through the dividend reinvestment plan. It's also very important not to sell something for a loss in a brokerage account and then turn around and buy it inside of an IRA. Because if you do it within 30 days, not only does it trigger the wash sale, you'll actually lose the ability to deduct that loss forever because now it's going to be stuck inside of that IRA tax shelter. And as we know, there's no tax implications until you pull money out of an IRA. So then trading that money inside of the IRA and leaving it in there, but you're essentially disallowing any loss that you would have had from the brokerage account. So that's something very important to keep in mind. And just so you know, I did make a more in-depth video on wash sale rules a few months back. I would recommend going and taking a look at that video because it's going to walk you through all the nuance and all the different rules that you need to be aware of in order to avoid this costly penalty. The third mistake that I see is holding tax inefficient investments inside of a brokerage account. Investments like bonds, REITs, and actively managed mutual funds can add thousands of dollars to your tax liability because of their inherent tax inefficiency. If you hold them in a taxable account, you end up paying taxes on their distributions every year. And for high earners, that tax bill is especially brutal. Mark is a great example of this. He's got $1 million invested in bonds, REITs, and actively managed funds in his brokerage account. And each year it's spitting out $35,000 worth of taxable income. This is money that will be taxed at either his qualified dividend rate or his ordinary dividend rate, depending on what type of distributions these are and how he's getting this money. It's really important to avoid these types of investments inside of taxable brokerage accounts. Save them for the qualified retirement accounts. Like I said, the smarter approach is to keep these bonds, REITs, and high turnover mutual funds inside of your IRAs and 401ks. In your taxable accounts, however, you want to think about holding low turnover index funds, individual stocks, or following some sort of direct indexing strategy that'll produce less capital gains and dividend distributions throughout the course of the year. These things don't generate a heavy tax bill like the counterparts we just mentioned. And also a quick note on mutual funds. They provide something called capital gains distributions throughout the course of the year. And oftentimes in mutual funds, the trading is done by the fund manager themselves. And this will trigger capital gains inside of the fund. So they may have sold Apple stock at a $10,000 gain and bought something else like Microsoft, like we just talked about in the last example. But let's say you own 10% of that fund. That $10,000 gain of Apple is going to distribute $1,000 worth of capital gains to you, even though you did no trading throughout the course of the year. And you indirectly realize that $1,000 gain because they're passing through your proportionate share of that $10,000 gain. This is another reason, and really the main reason I dislike mutual funds inside of taxable brokerage accounts, because it's really hard to peg down what the exact tax implications are going to be until December 31st of the year when all capital gains distributions have been realized for the year. And you're kind of just blindly hoping that it's not going to be that much money. So stick with the individual stocks, the ETFs, and the direct indexing strategies inside of your taxable brokerage accounts. Now, do you want to make sure you keep having a tax-efficient investment plan and investment strategy? If you do, make sure you subscribe to the channel, give this video a like, and stay tuned for more strategies to grow and protect your wealth. Also, don't miss out on any updates that we're providing by clicking that little bell icon on the bottom right-hand side of the screen. Every time we produce a new video, it's going to pop up on your YouTube channel, and you'll make sure you're not missing any of the important updates that we're giving out on a weekly basis. Thank you so much for being a part of this channel, and I hope to see you here for a long time to come. The fourth mistake that I see is paying short-term capital gains tax rates because of frequent trading you're doing inside of your account. When you sell investments that you hold for less than a year, you are going to pay ordinary income tax rates on those. And that is taxable at up to a 37% rate on the federal schedule. Now, if you hold those investments for a year or more, you're going to pay long-term capital gains tax rates, which are going to be 15 or 20% depending on where you fall on that taxable income schedule we went over at the very beginning of this video. So take Jenna, for example. She made $50,000 from short-term trading this year, and she had to pay $18,500 in taxes. If she simply held her investments a little bit longer, say, just past a year, she'd have been taxed on 20% of that $50,000 or only $10,000. So she effectively doubled her tax bill almost by not waiting the full year. This is why it's so powerful to understand why holding investments rewards long-term investors. Now, if you can make a big profit in 1 year because you placed one good trade, great, good for you. Typically, it makes sense to get out of the position before it has a chance to pull back. But if you're a buy and hold investor, trading frequently throughout the year is often a tax liability that will take up any of the excess return that you're earning through the frequent trading. So just something to be cognizant of as you're working through the trades that you're doing in a given year. One way to offset this if you are a trader, though, is to follow something called a direct indexing strategy with aggressive tax loss harvesting as a complement to the actively traded portion of your portfolio. This account should aggressively harvest losses, which can offset some or all of the gains that you have from trading in a profitable year. This is an effective way to help reduce taxes and to give you the best of both worlds, the frequent trading that you like to do and a nice long-term strategy that's more tax efficient. The final mistake that I see investors make is forgetting about the state tax rates on capital gains, as well as the net investment income tax. Many investors focus solely on the federal tax rates, but for high earners living in states like California or New York and a plethora of others, state taxes can take a huge bite out of investment gains. Add in the 3.8% surtax on investment income if you're above a $250,000 threshold if you're married filing jointly, and $200,000 if you're a single taxpayer, and your effective tax rate is going to be much, much higher than what you've previously anticipated. Investors normally find this out the hard way. Let's say we have somebody who sold a stock for a $100,000 gain, thinking they'd owe just 20% in federal tax. But after adding in California state taxes, that's where they live, and the surtax, this investor lost nearly 37% of his gain in taxes, a little over $36,000. That's almost as much as it would have been on the ordinary tax schedule, or the ordinary income rate tax schedule. So to protect yourself, always factor in your total combined tax rate, federal, state, and surtax. If you live in a high tax state, consider investing in municipal bonds or U.S. treasuries to reduce your overall tax burden. And if you're planning to move to a lower tax state, time your big asset sales carefully. We want to realize taxes when you're in the lower tax state as opposed to the higher tax state. I'm in Pennsylvania. So let's say we have a client in California who wants to move to Pennsylvania for work, but they're also planning on doing a big sale of assets that are going to have capital gains tax implications. We'll actually wait until the year in which they establish residency in Pennsylvania to make that sale, so they pay a lot less in taxes, sometimes to the tune of 15 to 20% less in taxes than they would have paid under the California schedule. Let's quickly recap everything we just went over today. We want to avoid holding high dividend stocks in taxable accounts. We want to be careful with tax loss harvesting and avoid triggering a wash sale. We want to match the right investments to the right accounts, hold investments long enough to qualify for long-term capital gain tax status, and don't overlook the impact of state taxes and the 3.8% net investment income tax surcharge. If you'd like help building a tax-smart investment strategy customized to your situation, feel free to schedule a consultation. The link is in the description below. And if you found today's video especially helpful, don't forget to like, subscribe, and share it with a friend who could benefit. Thank you so much for watching, and I'll see you in the next video.